Hey guys, welcome to a live market update with Buying South Florida. So today we're looking at whether it makes sense for someone to wait for interest rates to go up and therefore lowering the market value of properties versus somebody buying now with a little bit lower rate but higher market values. It's a question I often get, and it's a lot of people have different opinions, but I like to bring it down or break it down to the numbers and just kind of calculate a scenario where we are buying now at a low interest rate versus waiting maybe a 12-month period where there's a market adjustment in values, and now we're buying that same property at a lower price but a little bit higher interest rate. So let's take a look at first. I want to take a look at the 10-year treasury bond. We can see that over the past 3 months the treasury bond has been on the rise. Now, traditionally, mortgage interest rates do follow this treasury bond. Now, if we look back and we zoom out, maybe we do a year, we can see that the mortgage rates aren't particularly, they're higher, of course, than they've been over the past few months. But if we zoom out even further back at the beginning of the pandemic, we can see that we are back to or almost back to what the rates were before COVID. So let's take a look at whether it makes sense for someone to buy now with a higher market, right? So there's a rule of thumb. There's a rule of thumb in real estate that says that every 1% increase in mortgage interest rates, there is a 10% decrease in property values. That has to do with how much someone can get approved for. So here, we'll take a look at, and I'll explain that scenario now. So we'll take a look at $350,000 home purchase, and the the example that we're looking at is going to be on a conventional mortgage fixed for 30 years. So let's say single family residence for 350, 5% down, which is the minimum required for conventional loans. There are some times that you can go down to 3% on conventional, but there's some income limits or restrictions and so forth. So it's more common to do a 5%, right? 30-year mortgage at an interest rate of 3%. And then we'll look at property taxes, 1.2% of the property value, property insurance, and mortgage insurance. Anytime that a buyer gives less than 20% down, you will have mortgage insurance on the property. Now, the better the buyer's credit score is, the lower the mortgage insurance is on conventional. Now, if this were to be an FHA loan, the mortgage insurance is always fixed no matter what, and it's 0.85. But in this case, we're assuming someone has good credit, so a little bit lower mortgage insurance than they would have otherwise in the FHA loan, right? Then we'll put in, annual increase of 3%, property insurance of 3%. There is no homeowners insurance. Then we'll hit calculate, and then here on the right, we are assuming a 1% increase in interest rate and a home price decrease of 10%, right? $35,000 decrease. So now we're buying this same property 10% less than we would have otherwise. Now, remember, in real estate, it takes a little bit longer for the real estate market values to adjust like this, right? It's not like it happens overnight. It's not a crash that we are doing this exercise on. We're looking at a gradual decrease in property values over time. Okay. And, I think a 12-month period is something that's realistic in terms of a decrease of 10%. It gives time for the market to adjust for a higher interest rate and so forth, right? But 315 home value, down payments, everything's essentially the same as this example here. So we'll hit calculate there. And now we see that rule of thumb where it says 1% increase in mortgage rates equals a 10% decrease in property values. And the reason is affordability. You see this monthly payment here. This is your principal and interest payment on a $350,000 purchase. And this is your principal and interest payment on that same property, 10% less in value, 1% higher in interest rates. It's about the same, right? And the reason why that matters is on conventional mortgages, here on the right, the rule of thumb for pre-approval is a debt to income ratio of 40% front end. The front end ratio refers to 40% of the housing payment, or the housing payment in this case being the total 2096 cannot be more than 40% of your monthly income. So what I did here was an annual salary of 64,000. We plugged in the mortgage payment here, the 2,120, and we put in just one debt of a car payment of $265. Right, so I put in the 265 so that you can see a difference between the front end and the back ratio. The front end ratio only includes your housing payment. The back end ratio includes your housing payment and all other debts. The rule of thumb there is 45% on your total debts, right? There are some exceptions. FHA can approve you for more, and VA loans can approve you for more and things like that. But for conventional, for the purpose of this exercise, we'll assume the rule of thumb for debt to income ratio, which is 40-45, right? So at a mortgage payment of 2,120, we can see that client's or that buyer's debt to income ratio is right at 40%. So if you were to buy this same property, 350,000, at 4%, you wouldn't qualify. The payment is too high. Therefore, the market has to adjust a 10% lower so that same buyer is able to buy that property. And therefore, you get the rule of thumb of that 1% increase equals a 10% decrease in property values. So now the question is, should somebody wait, right? Should me as a tenant wait for the market to adjust and decrease 10%? Now, there's many market factors that influence the property values. It's not only interest. Interest is one of the things that influence that, and it will have an impact. However, things like inventory, location, etc., there are some other factors at play here. But looking only at an increase in interest rates and whether that will trigger a 10% decrease in property values, and whether you should wait or not. So you can see here pretty much buying the property at 350 now with a 3% rate. It's about the same thing as if you were to buy the property 10% lower with a higher rate. You can see that the mortgage insurance did change because that is based on the loan amount, but the difference in payment is not much. The difference in payment here it's about $24 a month. It's not a make or break budget situation. So what does that tell us? It doesn't make a difference for somebody to wait for the market to adjust down the 10% if you're going to pay 1% more in interest. Now, if you guys have been checking on the trend of recent mortgage rates, you can see that mortgage rates are almost up an entire 1% already. So we're almost back to pre-COVID levels on interest rates, and the market still hasn't adjusted. And in my opinion, it won't adjust until maybe the end of this year. So if you're on the fence about buying the property or a property because the market is going to decrease, now the question has to be how much do you think the market is going to decrease, right? If you think that it's you're better off waiting to the end of the year and so forth, think about a $350,000 property. Maybe it's a 3-2 single family residence somewhere, 3-2 townhouse. Those properties are easily renting down here in South Florida for about $2,200, depending on the property, maybe even more, right? Let's say $2,500 for a property. So you're going to sit on the sideline waiting for, let's say, 12 months for this property to adjust 10% down, where you may not see a 10% adjustment in 12 months. It may take longer. So you're holding out for a decrease of $24, but meanwhile, you just paid $30,000 in rent for that whole year. So you paid in $30,000, which you didn't or you could have paid towards your principal. So it's not a matter of opinion at this point. It's just a matter of the numbers, comparing whether you should wait or not. It doesn't make sense for someone to continue to wait on the sidelines, continue to pay rent instead of buying, right? Now, that whole first year, or if you would have given, $30,000 towards, you would have paid down your balance instead of just paying into a rent where you're just never going to realize any equity, anything by paying rent. Rent doesn't go away. You can't pay off rent. You can't, turn 62 and a half, retire, and suddenly the rent goes away. It doesn't work that way. The mortgages do get paid off after 30 years. Sure, you'll have, property taxes to pay. You'll have some property insurance, maybe, but at least you won't have a mortgage after 30 years. After 30 years, you'll still have rent. You can't pay that off. So if you ask me, 100% it makes sense for someone to buy now rather than sit on the sidelines and wait. Even if we look at a lower rental payment, let's say we look at 1,800, right? Which your monthly payment is still about the same. If you buy a $350,000 property now, your total monthly payment, including taxes, insurance, mortgage insurance, is $2,120, right? It's about a $320 difference a month. But here you're paying rent, and over the next 12 months, it's going to be $21,000, almost $22,000 in rent that you could have invested in a property, right? So again, every scenario has their exceptions. There are some cases that it may make sense for someone not to buy and so forth, but more often than not, I would say, almost 10 out of 10 times every time, it just makes more sense for someone that's renting to buy. It doesn't make sense for someone to sit on the sidelines to hopefully potentially wait for a market correction that may not come. It may come later rather than sooner, and then you end up paying so much more in rent, which you'll never get back, and ultimately it just doesn't make a difference on your budget. So I hope this scenario helped answer some of your questions and concerns. I hope that if you're sitting on the sidelines, you can see clearly that numbers don't lie, and it just doesn't make a difference for somebody to wait. Now, with that being said, if you guys have any questions, if you want me to address any particular concerns, leave a comment down below. You can shoot me a text, and I'll be more than happy to help. Otherwise, be safe, guys, and until next time, see ya.